Welcome to another episode of Unlocking the Upside. I'm your host, Jeff Robinson, and with me today is James, our resident market skeptic and former buy-side analyst. Today, we're diving into a fascinating topic that's revolutionizing how we think about markets, complex adaptive systems. James, I know you've been skeptical about traditional market efficiency theory for years. Markets are supposed to be rational and predictable, but what if the entire foundation of modern financial theory is fundamentally flawed? The evidence suggests we've been looking at markets all wrong, and the implications are staggering.
That's fascinating. And when you look at the historical record, it really challenges everything we thought we knew about how markets work.
Just consider this. In 1987, we saw the market plunge 22.6% in a single day. Traditional financial models said this kind of event should happen once every few thousand years. Yet we keep seeing these supposedly impossible events. The 1998 LTCM collapse, 2008 financial crisis, 2010 flash crash, 2020 COVID crash, all within just a few decades.
So if these events keep happening, there must be something fundamentally wrong with how we're thinking about markets.
Exactly right. The traditional view assumes investors are rational actors making optimal decisions based on perfect information. But reality shows us something far more complex. Markets behave more like living ecosystems than mechanical systems.
Could you explain what you mean by that comparison to ecosystems?
Think about an ant colony. There's no central planning committee, yet somehow thousands of individual ants create incredibly sophisticated behavior patterns. Markets work similarly through what we call complex adaptive systems. Patterns emerge from countless interactions between traders, investors, and institutions without any central control.
That's quite different from the traditional economic models I learned about in school.
And here's where it gets really interesting. These systems have feedback loops that can amplify tiny changes into massive effects. The dot-com bubble is a perfect example. Initial price increases attracted more investors, leading to more price increases, attracting even more investors until valuations reached absurd levels.
So it's like a snowball effect that keeps building on itself?
Precisely, and what's fascinating is how these patterns can suddenly shift or break down at critical points. What scientists call phase transitions, like during the 2010 flash crash, when markets suddenly shifted from normal trading to complete chaos and back again in minutes without any obvious external trigger.
The implications for risk management must be enormous.
They really are. Traditional value at risk models assume normal distributions, but we know markets have these fat tails. Extreme events happen much more frequently than they should. We need entirely new tools that can capture these systemic interactions and network effects.
That reminds me of how weather systems work. Small changes in initial conditions can lead to dramatically different outcomes.
That's a great analogy. And just like weather systems, markets are constantly adapting and evolving. When someone discovers a profitable trading strategy, others quickly copy it, making it less effective over time. It's like an evolutionary arms race.
So, how do investment professionals need to adapt their approach, given this new understanding?
Well, first, we need much more sophisticated monitoring systems that can track network relationships and system stability indicators. We need to look for early warning signs of potential phase transitions or regime changes. And our investment strategies need built-in feedback mechanisms to adapt to changing market conditions.
That sounds incredibly complex to implement in practice.
It is complex, but that's exactly the point. We need to embrace this complexity rather than trying to oversimplify it. The good news is we have better tools now than ever before. Machine learning algorithms can help identify patterns, network analysis tools can map into connections, and we have much better data about market microstructure.
Looking ahead, how do you see this understanding of markets continuing to evolve?
I think we're just at the beginning of this transformation. As we get better data and more sophisticated analytical tools, our understanding of market complexity will continue to deepen. But perhaps most importantly, we'll develop better ways to work with this complexity, more robust risk management approaches, more adaptive investment strategies, better early warning systems.
What would you say is the most important takeaway for someone trying to understand markets through this new lens?
The key insight is that markets are living, breathing systems that constantly evolve. The moment you think you've figured them out, they change. This isn't a flaw, it's a fundamental characteristic. Our job isn't to predict the unpredictable, but to build approaches that can adapt and thrive in an ever-changing environment. That's both the challenge and the opportunity in modern investment management. Are you ready to transform your understanding of markets? At Insight One, we're revolutionizing investment education by combining decades of market expertise with cutting-edge technology. Our platform doesn't just teach traditional theory, we help you understand markets as complex adaptive systems, giving you the tools to navigate modern market dynamics with confidence. From pattern recognition to systemic risk analysis, our interactive learning experience adapts to your needs, helping you develop a deeper, more nuanced understanding of market behavior. Join the thousands of investors who've already elevated their market insight at theinvestmentanalyst.com.